Today, the home price conundrum. Hello again, it's Martin North from Digital Finance Analytics. Welcome to the latest post covering finance and problem news with a distinctively Australian flavour. And today I want to take you deeper into my home price modelling, cover some broader perspectives on the financial system, and also talk about the upcoming show on Tuesday, which is a special. So with that in mind, let's get started. And the first thing I want to talk about is that next Tuesday, the 11th of August at 8 p.m. Sydney time, we're running the great debate on China. And this is the opportunity to hear from two experts in the field. On one hand, we'll have Robbie Barwick from the Citizens Party, who tends to want to give China a chance. And on the other, Salvatore Babones, who is a China expert. So it'll be very interesting to see how the argument goes, and you'll have a chance to participate live on the chat. So mark your diaries, Tuesday, the 11th of August at 8 p.m. Sydney time. It should be a zinger. Now, the next thing I want to discuss is a conversation I had over the last couple of days with a couple of market traders, and they made a couple of really interesting points to me. The first point they made was that if you look carefully at the statistics, the degree of machine trading has dropped through the floor. It's been very large since 2016, 2017. In fact, it was really the predominant force in the markets, but it seems to have wilted recently. And one of the arguments that they made to me, which I think is worth considering, is that the reason for that is that there are now many more individual small traders out there taking positions in the market. That's true of commodities, and it's also true of the stock markets and other markets too. And in fact, recent data from the US shows a massive spike in new accounts opened in the US with Charles Schwab, TD Ameritrade and E-Trade up 58, 149 and 169% year over year. And there's also been a significant increase in the number of new accounts and dormant accounts re-entering the market, suggesting that there is a lot of momentum in small traders. Now, the question you've got to ask yourself is, who are these people? What are they up to? And do they know what they're up to? And the answer is probably they are people who've got that government check and now are actually putting it into the markets. And so far, they'll say it's pretty easy. I put the money in and it goes up. The question, of course, is for how long? Remember that for every buy, there's a sell. For every winner, there's a loser. And if you talk to some of the professional investors, they are definitely still sitting on the sidelines saying this is an unsustainable market. It is definitely in for a fall. The question, of course, is when and how. But I suspect that the fall guys, if I can put it like that, will be some of these new entrants into the marketplace. So I guess a word of caution is in order. And in fact, I'm not the only one saying that. ASIC came out with a warning recently that said even market professionals find it hard to time the market in a turbulent environment. And the risk of significant losses is a regular challenge, ASIC cautioned. And they also made the point, here is an example from the Australian Real Estate Investment Trusts, that the market growth has gone through the floor, but the market activity has gone through the roof. And the question is, are those two things consistent with each other? And the short answer is, no, they're not really very consistent with each other. Begs the question then, do people know what they're getting into? Bearing in mind, of course, that many real estate trusts are relatively illiquid, and bearing in mind that they have very significant exposure to commercial property in Australia, which I am looking at and worrying about mightily at the moment. There seem to be a number of cracks emerging there too. So I just wonder whether everybody is fully up to speed with what's going on, or again, are we seeing this phenomenon of the market effectively running ahead and sucking up small and inexperienced investors who potentially might be taken to the cleaners later. We'll see. Now, of course, the markets may go on up from here for a bit longer, but at some point, we think gravity is going to reassert itself. And just on that point, it was quite interesting, and I've spoken about this briefly before, but just to reiterate it again, there was an interesting model I came across, which is looking at the fair value of gold and making the point that gold is driven by real interest rate expectations, the speculative premium and discount, and of course expectations on inflation, plus a series of secondary factors from the US dollar, central banks, wars, bad news, jewellery demand and mine supply. But the point is, the fair price model for gold can range anywhere between up to $5,000 at one end down to around $1,000 or below at the other end, depending on your assumptions. And all I want to say is that it is extremely unclear at the moment which way gold is going to go. And I know a lot of people are very bullish on gold, but there also are significant risks here too, not least the connection between the underlying and the massive multiple of derivatives that are out there, many of whom are now needing to crystallize those derivatives. And in fact, there is significant demand in the short term for gold to be able to close out those contracts. But the question is, will that continue? And as I say, if you run those various scenarios, you can see gold in one of two directions, up or down. So again, I just caution that this is also an area to be rather careful about at the moment. And just it's worth reflecting on this point too. This data came out recently from the RBA, and it's highlighting the fact that broad money is now 10.2% higher compared with last year. Now that, of course, is partly thanks to government stimulus, plus the other steps that have been taken to try and support the market. The question, of course, is where is that money going to go? Because there is an argument to say that if it goes into buying real things, in which case that could put demand up and therefore inflation up, or is it going to flow into financial markets, which will lift the price of financial assets potentially, but not have a very significant impact positively on the broader economy, and in fact could exert deflationary pressures on the economy? And as I've said several times, I am not clear in my own mind as to whether our economy and other economies around the world are going to move into an inflationary phase or a deflationary phase. And of course, that's important because different strategies need to be adopted depending on whether it's going to go up or going to go down. And just a couple of other data points that I just want to underscore. So APRA released data on deferred loans, and there is a significant proportion of people who've deferred their mortgages. We're seeing that coming through in our data as well. And you know, the total numbers we're talking about, 11% of housing loans or 195 billion, and 17% of business loans is significant. The question, of course, becomes what happens ahead? Can people re-establish themselves, and will they be able to start repaying those loans? Or will there need to be a conversation between the bank and the borrower in terms of an exit strategy? And we're already seeing property listings rising, and my own view is that they will rise higher from this point. And if you look carefully at what APRA has done, they've basically given the banks 4 months to have a conversation with prospective borrowers who are having difficulty with their mortgages to work out what they're going to do. So expect a flood of property coming into the market between now and early January. And just a quick update on super. Of course, super is continuing to be released. That's one of those other factors driving the broader money supply. $29.4 billion released so far, more probably to come. A lot of younger people are pulling money out of super, and in some cases are spending it, buying cars and what have you. Some are saving it, and some are using it for everyday expenditure. But I have to say, this whole situation looks to me to be not very sustainable. And of course, many people will end up without super in their funds, which means that 20 to 30 years down the track, they won't get the benefit of compounding. That could be a problem, particularly with interest rates so low. So it might be fixing something today, but it might also be creating a bigger problem tomorrow. And some people who are pulling superannuation out are actually not those who are directly impacted by COVID, according to my research and other researchers out there. So the ATO may come knocking as well. Household confidence fell once again. And this, of course, was before the Melbourne lockdown. I'm sure we're going to see a further fall ahead because, of course, Melbourne is now even more significantly impacted. And unemployment continues to be troublesome. The RBA is now saying 10% by the end of the year and maybe 7% a couple of years later. Those are very big numbers. A significant proportion of people, of course, are also underemployed, and Roy Morgan's latest statistic here is 23% of underemployed and unemployed people. That's a very big number. That's going to be a big drag on the overall economy. And of course, retail turnover also rose in the month, but there was quite a lot of movement from sector to sector. And what's interesting also is that online is still quite buoyant, but this isn't necessarily a particularly good news story insofar that if you look longer term, you'll see that in fact, in value terms, the retail is still looking pretty weak. And of course, we've got this stimulus cliff. Now, this was information that came out from UBS, summarising the government situation before the latest announcement of an additional 15 billion or thereabouts to support those in particularly Victoria, but also elsewhere around through JobKeeper. But you can still see the cliff from third quarter to fourth quarter is substantial. And I'm quite concerned by this significant drop insofar that there will be many people who have become used to a level of government support which may be now going away. Now, of course, there is always a chance that they will actually extend it and increase the reach and support. They probably should, given where we are. And we also, of course, have many people like students, for example, and other casuals who are not really being supported at all at the moment. That's probably unsustainable too. So expect to see more government investment over the next 4 to 6 months to try and keep the economy higher. But nevertheless, currently, the cliff is there and it's getting worryingly close. And just to recap on my mortgage stress data, which I went through in detail in the week, there is a significant rise again. We've got more than 1.5 million households in mortgage stress, rental stress is up, and property investor stress is up. Now, that's quite important because that information flows directly into my broad modelling. And in fact, the number one question that I'm getting at the moment through the blog and even on YouTube is, can you guess? What do you think home prices will do in my postcode? I think that's quite significant because there is a lot of interest about the broad economics, but of course it really comes home to roost when you want to think about your individual location and what's going on there. And I've had more people ask than ever before, what do I think will happen? Now, I've been doing quite a lot of work on this. And of course, my core market model enables me to look at a lot of information quite quickly and use my consumer surveys and business surveys to build a set of scenario models as to what's going on. That model, of course, has been around since 2002. It's been made more sophisticated over time. It's got a lot of other elements in it now, and that drives our mortgage industry reports, information on the DFA blog and elsewhere. I should also make the point that the surveys come in every week, so it's very, very dynamic. It's 0.5% sample across Australia. It's statistically optimised to be accurate, despite the fact that it's only 52,000 households, and over time it's proved to be remarkably accurate and precedent in terms of what's happening. Now, the core market model actually also powers our home price scenario engine, and that's what I want to talk about now, because we're going to start sharing more information directly out of our model. Now, we take our mortgage stress data, our house price trajectory, and units as well, of course, so we can get a sense of where prices have come from. Also, the buying and selling intentions from our surveys, which is a softer set of data, but very important in terms of, are people looking to buy or to sell? Are they property investors? Are they owner-occupied borrowers? And what about first-time buyers? And what about migration? What's happening in terms of people coming into the country, because they could potentially be a source of demand, and also that gives us a read on foreign buyers, as well as the broader economic data, including things like CPI expectations, wages growth or not, and employment and unemployment. All that information, of course, is folded into my core market model. And that core market model is what drives our overall scenarios. And as I've explained on a number of occasions, we run different scenarios looking at different sets of outcomes because it's very unclear as to precisely how this is going to play out. But over time, you can see how I move the probabilities based on what's coming out of the data. So it's data-driven against all of those inputs. And this allows us then to form some views about what property prices might do. But of course, it's scenarios, so we don't have a single definitive view. And we calculate property price expected movements at a postcode level and then roll them up to a region, a state, and to all Australia. And that's what feeds our top-level scenarios. But we can actually look at this in more detail too. This is an example. Now, to really understand how this works, it's worth just spending a bit of time to look at the chart here. So we have essentially a current point in time, 12 months, 24 months, and 36 months. So this is a 3-year view. And basically we have a cumulative scenario for home prices. And we actually run 3 scenarios. The first scenario is what I call the low scenario. So that's the one that if everything goes well, if that plays out in line with what other people are hoping, what may happen. So that's, if you like, the top line. And you can see in this particular one, this is for all Australia up till July. We're saying that on a good day, if everything goes really well over the next 2 or 3 years, we might see a 5 to 6% drop in average prices across Australia. Then we also have our bad scenario, our high scenario. And in that scenario, we're saying there is a chance that home prices could be 30 or more down % in 3 years' time. And then we have our base case scenario. That's the yellow dotted line. And that is our best estimate based on all the information we have as to what's going on. And at the moment, over 3 years, we're forecasting a cumulative drop from where we are of around 20%. And that's based on a series of assumptions in terms of what's going to happen to COVID, the CPI, all the other things that we've been discussing earlier on, all feeding into the model. Now, the beauty of this model is that I can look at it not only at the Australia level, which is the one I generally report, but I can also go granular. So, for example, if we take, the ACT, let's go there first. So this is the ACT cumulative. And you can see there that the midpoint is 18.5% down over the next 3 years, with a bit of a spread between around 5% and around 30%. So it's quite broad. The reason that the spread is so wide is because there are so many variables, which means that it's very hard to be completely definitive. And I think this is a much fairer way to show what's going on. Now we could look at New South Wales, and we see a somewhat similar story, down 21.5%, again, with a scenario that's most positive, less than 10%, but also another scenario that's more than 30% lower over 3 years. So somewhere between those 2 points at the moment, based on the data, is the truth. And we think 21.5% is about the middle point. Now, of course, there are some markets that are doing quite well. And Tasmania is an example of that. And in fact, in Tasmania, we're still forecasting a small rise at the moment. Our best scenario would be around a 5% improvement over the next 12 months in Tasmania. But the real midpoint is just a couple of percent higher, and then sliding away down to 17.1% over 3 years. And again, the baseline negative scenario is down to 30%. And you might be asking about Victoria, because of course there Victoria is looking pretty worrisome at the moment. And in fact, on our scenario, even on the best outcomes, we think there will be a 10% drop in home prices over the next 12 months. And it could be closer to 12% next 24 months later, and slightly better over 3 years. That's the sort of the very best that we can assume. And that's assuming that COVID gets under control and that the economy begins to recover later in the year. The midpoint is for a 3-year drop of 23.5% and a worst case scenario of more than 35%. But of course, this is the worrisome part about that. This is a very significant indication of trouble ahead for Victoria. I'll just show you WA as well. Now, WA is looking a little less risky at the moment, still down. And of course, WA's dropped more than 20% over the last few years and more than 2% the last quarter. Nevertheless, we still think there's more room on the downside. And our very best scenario is a couple of percent down over the next year, followed by a slightly further slide to around minus 5% and maybe 6% lower. That's the very best one. The worst one, around 30% down. The midpoint is down another 18.9%. Now, I can also go granular. And here's just one example. Albert Park in Victoria. This is postcode 3206. And here you can see that there's a rather similar trend to the overall Victorian story, but a bit different. A drop of 10%, very small drop the second year, and then a slight recovery. That's the best scenario. The worst scenario is a significant drop, and about 23.2% is my midpoint at the moment. But again, next year in this postcode is looking pretty worrisome. And I'll just pick one other Victorian postcode, and you'll see that there's a slight change here. This is for Clayton South 3169, down 24.2%, so slightly bigger drop. Similar sort of shape, but again, some significant risks. Now, we have this data for every postcode in the country, and we update this data every week as new information comes in. So this is a moving feast. These charts do move around quite a lot. And it shows, I think, the importance of getting granular and trying to understand what's going on locally rather than just looking at high-level indices. And again, I must say, these are scenarios, and the way we've presented this data is not a projection. It's an indication of the range of outcomes that are possible between the best and the worst. Now, if you want to get more information about what we are up to, you can, of course, get information via our Patreon site. And in fact, it is feasible there to subscribe to get our mortgage stress, rental stress, and investor stress, which is available every month. It's $50 a month plus GST. And we have quite a few people who have subscribed to that. And so they receive monthly updates about a week after the month end for every postcode in the country. That gives you the mortgage stress data, but it doesn't give you the price data. If you want individual price data for a postcode, that's going to be a rather different route. And we have actually launched something called DFA 1-to-1. And DFA 1-to-1 is essentially a chance for you to discuss with me a particular postcode. And we can go through all the information that we have. Now, of course, I can't give specific financial advice, but I can give you data on a given postcode and then look at the underlying trends and specifically share some of the information with regard to the next 36 months. Now, all this information, that includes stress data, home price trend data, and the price trends ahead, are all available from our model. Now, if you want to engage around this, the way we do it is that you'll need to book a time with me, either Zoom or phone, and we can spend up to an hour looking at a particular postcode and going into some detail and teasing out, if you like, some of the key issues that you may want to think about in that particular postcode. Now, it's difficult for me to do more than one postcode within an hour, so I tend to say to people, ask me about a postcode, not a long list, because I can't do justice to the analysis. I have to do quite a lot of background work, and that means that there's a limited amount of time and effort that I can put in, and it also means there's a limited amount of people that I can engage with directly on this. Now, to make this economic for me, I am charging $100 plus GST, payable in advance. And I've already had a number of people sign up, so we're quite full for the next week or two. But if you're interested beyond that, happy to give you more information and let you sign up. And the way you do that is you go to my blog, digitalfinanceanalytics.com/blog, and there you can contact me and arrange to talk to me about having a DFA one-on-one. And what I'll do is, if you contact me by the DFA blog, I will send you back some information and ask some specific questions. Once I've got those specific questions, I will then come back and book with you a time, do the background research, and provided that we get the payment in advance, we'll then lock it in and have a conversation about a specific postcode so I can share with you the information like I've shown you today. Now, the reason I'm doing this is because I think it's really important at this time to get as granular as you can and to understand what the dynamics may be in the marketplace. And that is because I don't believe that at the moment a lot of the tools that are out there are very helpful. We know, for example, that a lot of sales data is late and partial. We know that some of the indices that try to give a forward view of value are way overstating current values. I did some work for one of my followers the other day, and there we saw that the actual sale price for this particular postcode was on average 600,000, but the average asking price was 740,000. And of course, it's the 740,000, which is the one that all of the indices point to. But the reality is settlements are tending to be significantly lower. So it's very important to get a sense of what the real value range might be. And if you take my scenarios, what you can then do is essentially begin to work out some cash flow information based on different scenarios and make your own decision. I don't tell you what the right answer is, but I can provide a range of information to assist. And that's really what I wanted to cover today. So if you are interested in getting more information about the Stress series, you can contact me via Patreon. The links are below. And if you would like to engage with me on a one-on-one basis, we now have a service that allows you to do that. Just a caution, I've had significant demand for this, so it will be perhaps a little time before I can come back to you, but we will endeavour to meet everybody's requirements as soon as we can. In the meantime, I'll be back tomorrow with more insights into finance and property news with a distinctively Australian flavour and with perhaps a little philosophy on the side. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.